Hello everyone, this is Leo Kelly and this is a Verdence Capital Advisor market update for December 18th, 2018. Well, obviously we've had a lot of activity in the market over the last couple months and specifically the last couple weeks. Volatility has exploded, multi-100 point swings in the market. It seems like every day the market is moving up or down, and unfortunately more often than not down in dramatic fashion. So what's happening? Well, there's a lot going on right now. We've got a very aggressive Federal Reserve that's raising rates. The market never likes when the Federal Reserve is aggressive. The concern is that they'll overshoot, push rates too high, and drive the economy down. We've got the Brexit happening, Great Britain's breakup from the European Union. Global earnings are slowing down. Oil is crashing. We're in a tariff war with China. There's a flattening yield curve, which scares the technicians in the marketplace. So across the board, we have all of these circumstances that are creating fear, and fear drives volatility. As we look at the S&P 500, we'll see we are officially in a correction. This chart shows the last time we saw these kind of moves were 2015. Since then, the market has moved straight up. We've enjoyed virtually no volatility in the market over the last couple of years. You may recall in our look ahead at the beginning of the year, complacency turning into volatility was one of our primary themes. Unfortunately, beware what you wish for, the volatility is coming. So the market is actually in a correction. If we dig under the covers, most stocks, more than half the stocks in the S&P and 75% in the NASDAQ are already in a bear market. So even though the indexes haven't officially turned over yet, the reality is this is pretty much a bear market, and this volatility is pretty severe. By the way, I just point out, the drivers of the S&P 500 going up recently, the FANG stocks, they're down 20, 30, 40%. I tell you that because they're driving the market down. There is no such thing as a sure bet in the market. When price gets too high, it's too high. And the market tends to surprise people with these dramatic moves down, just how far and fast they can go. Sentiment in the market is a big driver of volatility, and as we can see on this next chart, if we go back to the beginning of the year, 60% of market participants surveyed were bullish on the market, with only 16 bearish. Just recently, it was 46-25, and if you go to just in the last week, the last survey, we're down to 20% bulls, almost 50% bears. The market is completely reversed. Fear has gripped this market. We think that's driving the volatility. The good news on the next chart is that 12 months later, the last couple times we saw these ratios, 12 months later the market is up. In 2013, we saw a one-year return of 14%, and in 16 we hit that ratio twice. 1 year later, 18, and then in February 2016, 1 year later, 26. Even 6 months later, the returns are good. What does this chart tell us? It tells us that when fear gets into the market, that prices go down indiscriminately, and the market does tend to overshoot. I will say what this doesn't tell us is where the bottom is. Once fear grips a market and you leave fundamentals and you don't price stocks based on the fundamentals, just based on where they're going, direction, and momentum, price can pretty much go anywhere. So it's not a time to just jump in with both feet, but it is a time to look for opportunities. So the obvious question is, are we headed into a recession? Is this the beginning of something greater like a 2008? Well, we don't think so. There is a big credit concern out there, but it's not the same as we were in 2007 and 2008. In terms of the economy, as you'll see on this chart, everything is green. The green boxes indicate economic indicators that are above their 5-year average. And as you can see across the board here, things look pretty good in the economy. Jobs are good. The market is good. This next chart shows GDP has been very good over the last year since the tax hike. And even going into estimates for next year, GDP growth is still anticipated to continue to be strong. Maybe not as good as what it's just been, but still strong. Valuations are reasonable. The next chart shows they've dropped below the average here with this pullback. Last time that happened, 2015, our last correction. So I would say that the market is obviously creating a lot of concern. We're watching this volatility. Our suggestion is to remain calm. We are here to answer any questions that you have. Remember, this is a time where you have to stick to the discipline. We have asset allocation strategies. We'll be looking to rebalance portfolios. We'll be looking to look at our tactical allocations, see where there's an opportunity. We want to buy low, sell high. As price drops down below fundamentals, that's a time for us to stay calm, not get caught up in market sentiment, and take advantage of mispriced markets. So we're going to be looking at this. We're going to be looking for opportunities. And we're just going to ask you, remain calm in the face of fear. That's always what works. There's a reason why that bullish bearish survey is a contraindicator. So with that said, again, any questions, don't hesitate to call us. We're here to walk through that conversation with you. And finally, have a wonderful and happy holiday. We look forward to talking to you in the new year.